All right, welcome. Thanks for joining us. My name is Jason Pfaff. Appreciate everybody taking some very valuable time. Spend with us here as we talk about trading the volatility around major events with binary options. One of my favorite topics and one of the really key strategic ways I like to trade with Nadex is around major events. There's a couple of reasons for that, as we'll discuss, and hopefully you've got some questions or insights. Please drop those in as you have those questions or comments or anything you'd like to share to the chat box here, and I always do my best and think I do pretty well to get to all of those. So thank you in advance for adding your thoughts and questions. Anything to do really with Nadex, happy to speak to. Again, today our focus is on trading major events with binary options, and really one of the keys that major events bring to our trading lives is that level of volatility or price action, price movement. Often as traders, depending on the strategy we're pursuing, we're looking for volatility, we're looking for movement. And so that movement brought about by major events as those things roll through global markets. Certainly one of the things I love about Nadex is the opportunity to build a trade based on that. And it's just in general one of my favorite topics. And just honestly, it's a great time for this topic. We've got non-farm payrolls tomorrow, always one of the highlights of any month. And certainly this month, non-farm payrolls, if you're not familiar, is a release coming out of the United States. It's always the first Friday of a month on the employment situation in the United States, and the headline number that's tracked is always the net change in payrolls in the United States. So for instance, if the number is plus 200,000, that's the Bureau of Labor Statistics indicating that United States employers added, for instance, I'm just giving out a big round number as an example, 200,000 folks to payrolls. That's seen as a key economic indicator for the United States. Obviously, the United States being the world's largest economy and a real bellwether for global markets. We had the Fed, I believe, last week. We've got Brexit and speeches this week by the Prime Minister. We had a major oil release, inventory releases every week. That's a major event if you trade oil. The EIA reports Wednesday mornings. API always goes on Tuesday afternoons before the EIA release the following morning. That's an event I always watch closely each week. Just this morning with natural gas, we had inventories from the EIA for natural gas. You can trade natural gas with Nadex. You can track the inventory reports and build trades potentially around that natural gas release as well. So before we get started, let's look at our risk disclaimer. Appreciate you spending a moment looking through with this. Just want to remind everybody, trading always involves financial risk, may not be appropriate for you based on your risk tolerance, your goals, etc. Everything we're doing here today is educational in nature, and my sole purpose here is to educate and share information and my opinion about markets. Nothing should be considered any kind of solicitation to buy or sell any financial instrument. Also really critical, we'll look at some prior examples. I'll talk about some, historical or even hypothetical examples. At no point should you consider past performance as indicative of future results. And just a reminder, especially as we talk about the volatility that global events can bring, just know that trading can be volatile, and on any given transaction, you are certainly capable of losing your investment. All right, so let's get started. So, sorry about that. My name is Jason Pfaff. I am a proud Nadex educator. Love these types of webinars and educational sessions. Really enjoy sharing what I've been fortunate enough to learn about markets with individual traders. That's really my passion. Certainly love working with Nadex, as they are really built for the individual trader as well. I spend a lot of time in global markets, whether it's commodities, forex, metals, and again, from my point of view, I'm always interested in building strategies around these types of events as they move markets, offer volatility, and give us the chance to build trades. I spent a lot of time in a variety of situations forecasting things like GDP, oil prices, future Forex rates, and those things are always impacted by events. I often, folks will ask as we talk about trading events, you may consider yourself, for instance, a technical trader, and sometimes the event side of the equation can be more fundamental in nature. If you're technical and you trade, maybe Fibonacci or chart patterns, or you use a suite of indicators, folks always ask, how do I fold in an event-based strategy when I'm consistently trading based on other technicals? And ultimately that's for each individual trader to decide as you think about the type of trader you are and how you express yourself through trading. But I definitely think that all investors, all traders can benefit from understanding what events are on the calendar, what those events typically do to the assets that they trade, and how things may change based on that day or week or month's events. It'll be up to you to decide how you want to fold that into your individual strategy. Every trader I've ever worked with has always had some different flavor of what they like to do, but really our purpose today, my purpose today, is to share, here's some examples of some key events. Here's some examples of the way you can trade those with binary options, Nadex options, and here's some of the things that I've learned about building a strategy around that. The other things that you use as a wrapper around that, really up to you as a trader, whether you want to use RSI or you're trading patterns or some of those other indicators, Ichimoku, those things are all complementary to an event-based strategy. So trading events. So a couple of things just to keep in mind here off the top. One is be humble. At no point would I ever recommend, if you're, let's say, for instance, and I'll use a lot of examples of events. Let's say, we're going into non-farm payrolls tomorrow, and you want to trade non-farm payrolls. Let's say in currency markets, non-farm payrolls typically impact the dollar as it's, paired across the major FX crosses. If you don't have a really good angle on what you think, an opinion with conviction on how that report may turn out, it's okay to be humble and express that in the strategy that you pursue. We'll talk about some other strategies where you may not know the direction, you may not have an opinion on the actual event itself, but you want to watch for the volatility and build a trade around that. We'll talk about that, but really the first piece of this is, to be humble. No one really knows how these things turn out ahead of time. So definitely want to encourage you to trade accordingly. You want to have opportunities on your radar, but you also want to stay balanced and stay humble. You may trade NFPs or the oil release a couple of times successfully, but remember, stay humble. Every trader has wins and losses, and that's okay. Continue to learn from each and every trade and each and every opportunity, and just remember to stay humble. Again, nobody really knows how these things go ahead of time. We're always surprised, and honestly, I'm humbled each and every day I spend in the markets. Again, while we're talking here, events offer the possibility, the potential for significant volatility. Volatility definitely works both ways, right? It can work against you if you're on potentially the wrong side of a trade. It certainly works for you if your trade is working. So just stay aware. Volatility can be a roller coaster and definitely can work both ways on you. Already talked about the learning piece, but in addition to that, one of the things that I've really, as I was gaining experience as a trader, loved about trading events is not just looking at the trading patterns, but really understanding the nature of the event, the dynamics that go into that. It'll give you a better depth of understanding about the way markets are formed and economies work, and it'll give you additional tools in your tool set as a trader. So it's important, not, in my opinion, I recommend it, don't just learn about the event and the trading strategy and maybe a chart pattern and some of those things around the event, but learn actually, go a couple of steps deeper and learn about what makes this a major event, how that event comes together, and what it can teach us about markets. And fourth, and I truly believe this, Nadex options are, for me at least, a great tool to trade events. You've got the clear and defined and capped risk. You're never going to lose more than you pay for the trade. You can clearly and transparently express your opinion with conviction and build many different potential strategies in a pretty straightforward way with Nadex options. And again, really a few keys there. One is the idea of the capped or limited risk. You're not going to lose more than you pay for the trade. And as we talk about binary options, and maybe you're newer to Nadex, you're essentially with a binary answering a very simple question. Will the price be above or below at a certain point in time? Much more straightforward than if you've traded other option products where you're trying to string together some more complex options around an event. With a Nadex binary option, you're answering a simple question. Will the market, the underlying market, be above or below? Will it be above a certain strike price at this moment in time? For me, as a trader, especially scanning all of the different markets we have access to nowadays, the simplicity and clarity and straightforwardness of that type of approach really allows me to spend my time thinking about the level of risk I want to take on, the opinion I have of the event itself, and then I can really focus on building some very simple strategies around that. If you are newer to Nadex, a couple of things I would really encourage you to do, and you can do it right now while we're on the webinar. One is register for the free and permanent demo account, www.nadex.com/demo. You'll have virtual money in there. It takes 2 minutes or less to register, and you can trade live markets with the virtual synthetic money to really understand it from the perspective of the Nadex platform. Again, some of these strategies we'll talk about today with respect to events, how these underlying markets move, how the contracts work. So I really encourage you, go out, register for the demo account, use the demo account, take a look at the markets, take a look at how the platform works in the demo environment. The other piece is too, there's a fantastic suite of resources on the Nadex YouTube channel. I've got several other webinars out there. We did one on Ichimoku as a system a couple of weeks ago. We've talked about technical indicators. We talked about chart patterns 2 weeks ago. So go out, favorite the Nadex YouTube channel. You'll get updated as new videos are uploaded. There's some great playlists, some great orientation videos, in addition to some great trader education out there on the platform. So let's talk about volatility. Really the key ingredient here to our event-based strategy. So why do you want to trade volatility? Again, news and news flow and data releases and things that happen bring action and movement to markets. At its core, at a kind of larger conceptual level, volatility is a process of a market that's fundamentally a coming together of different people trying to agree on the price of an asset. Volatility can be thought of in one way as a measurement of the level of disagreement. Two traders are on either side of a trade trying to find some level of equilibrium and trade the price of an asset. The more volatility, it can be thought, the greater the level of disagreement, and the greater the price action as the market moves back and forth in an effort to find equilibrium. Now, and I know markets are always in flux and they'll always be fluid and it'll never find a perfect equilibrium, but trading is a process of trying to find that equilibrium, and volatility is the measure of the amount of movement back and forth as that market looks for that balance. The volatility offers potential for return or losses on the other side of the equation, and because it offers greater swings in price when a market is volatile. In addition, with Nadex options, there's opportunities, and we'll take a look at a great example in oil markets here a little later in the presentation, where if you have enough volatility, enough price movement in the market, you can design a trade where you don't even need to be right on direction. You just need to be right on the level of volatility that may come to that market, and you can still be on the right side of a trade if there's enough volatility. However, you want to make sure as a trader, you're aware of the volatility, you're aware of the environment, you want to plan ahead, build a strategy, and then execute that strategy as the event happens. So real quick, a quick 4-step process. This is how I tee up event-based trades. The first piece is you want to identify an event. Find your favorite economic calendar or tool, or maybe you're reading some articles about what's going to happen in the markets next week. Isolate some events. And I would really encourage you, if you're newer to event trading or newer to trading or newer to Nadex, find some events that interest you and some markets that interest you. Just because it's the biggest event of the week, if it doesn't interest you, you're not going to be as motivated, I think, to learn about it, and you may not do as much homework as maybe you would have if it was an event that you were really interested in. So, find a few events that you want to learn more about. Do some reading, do some researching, look in your charting tool at some past dates where that same event potentially occurred, and identify those ahead of time. The second piece is define the markets impacted, and kind of define through a process of thinking, researching, looking, what you think may or may not happen. Again, you don't have to be right on direction. You may just think it will be an event that brings significant volatility. So these could be things like, again, I mentioned earlier, inventory reports in energy markets. It could be a Fed meeting, which people expect may raise interest rates, and understand the markets that are potentially impacted by those events. In the event that it's a Fed meeting and there's a hike in interest rates, that will impact potentially the dollar. It might impact stock indexes. It might impact gold. And so through your process of researching, you want to identify those markets that you want to trade in and identify what you think may happen based on your understanding and opinion of the event. Third step, real simple, build your strategy around that based on those first 2 factors. Fourth, you want to execute and then manage your trade. One of the things that is really important, if you're trading in really tight time horizons, let's say again, we'll look at an example of the oil inventory report later, but this is true a lot of the time in most events. If you're on a tick chart or a really tight time horizon, looking at how the market's moving coming out of an event, the first couple of moves may just be dictated by large institutional investors, let's say, who have limits and orders already in for that underlying market, which could force some idiosyncratic moves in the underlying market. Those first couple of moves could just be the result of pre-programmed orders being filled, and could cause, on a tick chart at least, in a really tight time horizon, things to bounce around a bit. You need to manage your trade as the trader, as the potential investor, understanding that there could be some very, very short-term volatility that's a bit idiosyncratic in nature, and then from that event over the next few minutes, 10, 15, 20 minutes, maybe even up to a half hour, the market will really define the direction coming out of that event. So you want to manage your trade for sure. So the types of events we have, again, these are just some examples. Central bank meetings, not just in the United States. Again, we had the Fed. You can have the European Central Bank impact the euro, impact other markets, and impact European stock indices. You have that opportunity to trade those on Nadex. Central bank, and again, these are just a limited number of examples here just to get your brain turning on the types of events you can trade. But central bank meetings, one of the reasons those are really interesting to me as a trader is they impact so many different markets. Again, the Fed can impact everything from gold to stock indices to commodities and the dollar and the FX markets. So you really have, you may really be actively trading, let's say, gold or indices. And some folks might think of it as a central bank meeting mostly impacting the dollar and FX. Well, it does impact the dollar and FX, but it can also impact other markets as well. So you can understand the event and still trade based on what you think may happen in one of your favorite markets. Weekly market data talked about energy, indices. There's a lot of very regular data reports that come out on a weekly basis. Housing, there's always a lot of data coming out on mortgages or home construction or new home sales or existing home sales. So those weekly data releases that you can see on your favorite economic calendar are regular and routine opportunities to trade the same event over and over. And as a trader, you get into that cadence, you start to understand the event better and better over and over. If it's it's got a weekly or a monthly cadence, the next one obviously being monthly data releases. Things like GDP, already mentioned non-farm payrolls, those monthly, inflation, the PPI, the CPI, those monthly data releases also impact markets, and again, offer you a regular and routine series of events that you can really get the cadence and kind of the ebb and flow down as you trade the same event over and over. And then special events, right? We talked, for instance, about Brexit. This week we had some speeches by the Prime Minister. There's ongoing negotiations between the UK and the EU. Those kind of one-off, folks may think of those as more fundamental in nature, but OPEC may be coming out with an announcement on new production limits that really impacts oil markets, or again, there's another round of negotiations in the UK, or a whole host of things can impact markets. For instance, in stock indices, there's been lots of discussion around privacy, and we've seen big tech CEOs called to Capitol Hill to testify. I would consider that an event, right? And you could go on the Nadex platform and look at opportunities potentially to trade, let's say, the NASDAQ, the tech index, right? It's an event occurring in Washington, D.C. on Capitol Hill between, politicians and a CEO, but that can really impact a stock index built on tech. So you could circle that event and have an opinion on how you think that's going to go and build a trade around it on the Nadex platform if that fit into your own personal risk tolerance and strategy. So there's 3 core strategies I want to talk about. Again, you may have some ideas of some others. These are just 3 common, popular ones. These are ones that I like. And again, if you've not yet registered for a demo account, it's a great opportunity, nadex.com/demo, to try these strategies out in a demo way and really see what works for you. I tell traders all the time, they ask what strategy is the best. I say, it's whatever works for you. All of our brains work differently. Your brain will respond differently to a different strategy. So see what you're comfortable with and trade it. You can trade direction if you feel you have an angle on the way you think the event will break. The key here is not just knowing which way the event breaks, it's knowing which way markets will break as well. So you can trade that direction. Pretty conventional strategy. Most folks, when they think of trading, they think of needing to know which way things are going to go. But again, the key, and this is where a lot of new traders may have an issue, you don't just need to know which way the event goes, it's really which way the market breaks in response. That's in the underlying market, which way that goes, that's really what we're trading when we trade an underlying, based on an underlying market. You can straddle or strangle the event. We'll look at an example of this a little later. This is a popular strategy designed to make potential profits regardless of direction. This is what I was referring to earlier when I said what you need for a straddle trade is really volatility for a market to move, but you can put 2 positions on the same underlying market, and as long as one of those positions, the market gets to that strike, you could be profitable enough to pay for both trades and have profit left over if your trade works out the way you think it does. If there's not enough volatility, then that could work against you. And then you could trade momentum too. And I think this is sometimes an overlooked strategy. just my opinion, but when I talk to new traders, folks feel like they have to know the direction ahead of time to put on a trade, or they have to know which way things are going to break before they put on a trade. There are momentum-based approaches where you can watch the event closely. You could have a couple of scenarios you think may unfold ahead of time. And then you can really watch and closely monitor as that event transpires, as that market moves. You can see which way the market's breaking and potentially have opportunity to then place a trade based on that direction and still have upside. So one of your tools is an economic calendar. I just have a quick screenshot. This is from IG. Again, this is another area where the economic calendar that's best is really whatever works for you. But typically what you're looking for in an economic calendar is, just a quick, scan of the markets that are or the events that are on deck, and, times, and it's pretty simple, right? So have an economic calendar. I actually have 2 or 3 because, you can't guarantee that every calendar picks up every event that you may be interested in, but check it regularly for sure. Definitely, I like to Sunday night kind of tee up my week, pull the calendar, make sure I've got everything that I may want to trade kind of teed up on the calendar, lay that out for myself, knowing which day, which event is going to happen. And I'll be honest, even if you're not specifically trading specific events, if you're going to be active in the markets, and this is why I say even if you're a technical trader, there's nothing potentially more frustrating, right, than to have a position on, things are working in your favor, and then all of a sudden, boom, you're trading the dollar and inflation report hits and inflation's disappointing and your trade could go the other way. So those just a hypothetical example. It's definitely possible if you're not aware. Even if you're not trading a specific event, you still want to know what may be impacting the different markets you're trading. All right, so just a quick look at a couple of charts here, a couple of examples. This is the DXY, the dollar index. So this is a daily chart. Again, you can take it down to a tick, or if you're trading events, you probably want a 15, 30 or an hourly chart. But this is a little longer view. So we had the Federal Reserve meeting last week. This is the chart literally from last week, the DXY. And you can see here, the impact of the Federal Reserve meeting. This is a unique event in that I think the Fed, my opinion here, but has done a lot to telegraph moves ahead of time. I think most folks, if not all folks involved in markets last week, knew the Fed was hiking rates. But as a trader, the fundamental question I had was how much of that was priced in, meaning, markets already so expected a move, it wouldn't move the dollar nearly as much as it had in the past, and how much potential upside was left. Typically, past performance is never indicative of future, but historically, a rise in interest rates can lead potentially to an increase in the value of a currency. So you would expect over time, as the Fed raises rates, potentially, historically, we've seen an increase in the value of the dollar. Well, this was an opportunity where maybe you could, for example, have traded momentum. You could have watched closely the event. You could have tracked news flow and comments and actual actions by the Fed around the event. Again, in my case, I was thinking, I know what, this is an example I was speaking to earlier. You may think what the Fed is going to do, but you don't exactly know how markets are going to react. So you could put on a momentum-based trade, for example, if that fit within your trading plan, risk profile, etc., and really continue to capture upside after you saw that initial move in the dollar. You can see that nice long candle that first day coming out of the Fed meeting. Even if you waited for that to start to set up, you can see, okay, this is moving potentially topside. You could put on a momentum-based trade, and there was still plenty of runway to capture additional potential profits if you had placed a momentum-based trade after the Fed meeting concluded. You can see we've had a pretty steady rise in the value of the dollar since that trade. So I would consider this, hindsight's always 20/20, but looking back was a pretty good setup for a momentum-based trade. You had some uncertainty heading in, didn't know how markets were going to react, given everybody felt like they knew the Fed was going to raise rates, but you can see plenty of space to the upside. So this is also from early last week. This is a chart. This is dollar CAD, the loonie for you FX traders out there. So this is a situation, let's go back in time a little bit, just as an example, going back about a week and a half, 10 days. Over the weekend, news reports started to surface that the United States and Canada were close, if not, right at a new trade agreement, right? It was the update of NAFTA, the United States, Mexico, Canada agreement now that as it's known. So as a trader, you could say, hey, I'm seeing these news reports, over the weekend, I may want to trade dollar CAD, okay? And if you think about the three strategies we mentioned earlier, you've got the opportunity to trade direction, a trade agreement between the United States and Canada. I think most folks would have said at the time was potentially bullish for CAD when paired with the dollar. Dollar CAD, that means it would go down as the Canadian dollar is the second in that pair. So bullish for CAD means the dollar CAD would go down. You could trade based on momentum. You could say, hey, I see all these news reports. I know something is going to pop with the Canadian dollar, and but maybe not. Maybe markets, will decide something else. So I'm going to wait and see, and I'll put a trade on as markets open, see which way it's headed, and then maybe put on a momentum-based trade in that direction. Or, and we'll talk about an example here in an upcoming slide, you could think in terms of a straddle trade or strangle trade. I will save that here for a few minutes. We'll talk about an example with that in oil markets. Oh, sorry. So last example here before we get to the oil trade, this is a euro dollar. So this is last month's non-farm payrolls. Again, we have non-farm payrolls coming up on Friday, tomorrow. So you can see, as non-farm payrolls hit, this is euro dollar. So again, if it's bullish for the dollar, that means this will go down. Again, the interesting setup here is, going into non-farm payrolls, this non-farm payrolls will definitely, in my opinion, has normally brought movement to currency markets, right? So again, another situation where you may think you have an angle on non-farm payrolls and know which way it's going to break, or you may just think, hey, it's non-farm payrolls, it's going to be volatility. There's a couple of setups, again, in hindsight, you could have used on this trade. One is, again, your momentum trade. You could have put it on as you started to see it head down, but this is a case where, on the euro dollar, we moved down to just above that 115.30 mark, and it started to head back up. Maybe a momentum trade, it would have reversed on you as you start to put on the trade. Again, same thing with a directional trade, right? It headed down. You may have thought it was going down. You may have thought, hey, non-farm payrolls, this is going to be bullish for the dollar. Euro dollar might head down. You could have put on a directional trade, but again, you see as it kind of bounced and reversed on you. The third trade in our strategies for events is really the strangle trade, which we'll talk about next. But that's really a trade where you can have a market move in multiple directions. You can take multiple positions, not knowing the direction, not knowing where the momentum will lead it. You could put on multiple positions ahead of time with a strangle trade and still potentially end up profitable, where you pay for both trades and you still have some profit based on the potential volatility that you see in that market. So let's talk about a binary strangle trade. And this is a really interesting example. So let's get in our time machines. Let's go back in time to January 2017. We have a new president of the United States. This is an actual historical example. These are, real events that happen. And you're heading into the oil inventory report. So you're trading oil, you're going into the oil inventory report, and there's a lot of things going on, new president, inauguration coming up. So a binary strangle is a strategy if you're unsure about direction, as I said, but you're anticipating volatility. So what you would do in this example is you would buy a strike above the underlying market. You would sell a strike below the underlying market. And what you're looking for as a trader is for it to move one way or the other. In some cases, it could touch both strikes, potentially. And you could have one or both positions potentially be profitable. So in this hypothetical example, the trader's maximum risk is $20 net of, or not including fees, which is the cost to purchase both options if the orders are filled at 10. So your purchase of your strike at 52, which in this example is above the market is at 51.45. So let's say you buy for $10 a strike above the market at 52. Then you can sell a strike at 51 also for $10. So your maximum risk, not including fees, is $20. You've bought a $10 contract above the market, you've sold a $10 contract below the market. So now also, tip, make sure you're setting limits so that there's a potential for profit overall, even though maybe only one side is profitable. All you need as a trader in this example is for a move in one direction or the other. You've essentially paid $20 for both positions, and you need a move to touch one strike or the other. And again, in some cases, you could have such a volatile move, it may touch both. So in this case, let's say the trader can set a limit of 45 on the buy and 55 on the sell. Again, those decisions are up to you as the individual trader, but for the purposes of our example, again, risk is capped at 20. So if both trades reach their target, profit is 70. If only one trade reaches the limit, the profit is 35, right? So that's determined by the limits that we set. So if both trades reach their target, you could profit 70. If only one trade reaches the limit, your profit is still 35, even if only one of your two trades is profitable. All you needed was enough market movement to reach one strike or the other, move above one level or below the level that you had below the market. Now you can also, if you prefer, hold one or both of the positions to expiration. That would obviously adjust our example here. I'm using the example with, say you got a limit of 45 on the buy and 55 on the sell. But even if you hold both to expiration, your risk, what you would lose on the trade, is never more than your $20 plus fees. So you pay $20 plus fees for both trades. If it touches one target, your profit's 35. If you can touch both and close both positions, your profit would be 70. This is what's known as a binary strangle trade. Again, a real example of the market, at least from January 11th, 2013. Some of the details are, my own opinion on the limits and the prices, etc. But this is an example of where if you would have done a binary strangle, you could have had at least one of your positions be profitable at 35 potentially, which pays for both trades and gives you a profit. So if we go back one slide, just to give you again the perspective, we look at our euro dollar trade. If you had set up a strangle based on the underlying market here, and you would bought a strike above the market, sold a strike below the market, as the market moved lower, as long as it crossed the strike that you had under the market, your sell order, that trade would have been profitable depending on the price you paid for the contracts, even though the market eventually, after hitting your strike, reverses and heads back north. So you can see that action here where it heads above on the oil example. All right. I'm going to take a look at questions really quick. If you got questions or comments or really about anything with respect to Nadex or trading on Nadex, or certainly with events, let me know. I will run through the questions right now. Got a few questions about my email. I will put that up here in a second. All right. One question here, just on the nature of events that you can trade. Are any type of event more volatile than others? No. If you're looking for volatility, I think it'd be commonly held that the level of surprise, and the greater the level of surprise, the more volatile the market. But this is where when folks ask about what types of events or even what types of markets to trade, this is where I really just strongly encourage you to again, register for a demo account and check out all the markets that Nadex offers. It's one of the things I love about the Nadex platform. You've got so many different types of markets, and I tell traders all the time, my opinion, the market you're going to do best in is the market you find the most fun, the market you like learning the most about, because you'll work hard at it, you'll learn at it, it makes sense to you. So find the events that impact the markets that you like, that you have fun with, that you like discussing. And I think ultimately it's pretty logically to assume that those would be the markets that you are the best at. But I know great traders who trade mortgage application data every week, and how that can impact markets, or housing data. Other great traders trade the really big events, non-farm payrolls. Some like to track inflation data and how that impacts currencies. It's really how your brain works and what makes sense to you. All right. Don't forget to favorite the YouTube channel. This video will be out on YouTube, the Nadex channel. Just favorite it, you get all the updates. I'll put my email address here if you've got any questions on events, Nadex, anything at all with respect to trading. Would love to dialogue with you. That's jason@thedutchbook.com. Feel free to drop me a line. Just let me know if you've got other webinar topics. Would love to put together a webinar on some areas that you're interested in. Just let me know. But that's the content I had. Thanks for hanging out with me for a few minutes here. Thanks for your engagement. Good luck. Happy trading. Check the calendar. We got more great webinars coming up. Favorite the YouTube channel. And then until the next webinar, thanks for hanging out today, and good luck and happy trading.